Good afternoon once again, Market Rebels, and to all of our YouTubers out there in YouTube land. It's time for Trading Tune-Up. We do this every Monday, 4 p.m., right on the closing bell. Pretty wild ride today on Wall Street, to say the least. But that's why we're here, is to give you some insights into ways to make better decisions. And one of the most important topics I think that you can understand is one that is called risk versus danger. Now, usually in everyday language, we consider these synonyms kind of interchangeable. But in the world of finance, there is a distinction. And it's super important for you as traders to understand what that distinction is, because once you place a trade, things change. At a minimum, time's going to go by. That's going to change your deltas. That's going to change your gammas. Stock prices change, and that can throw a wrench into the works unless you know where to look. Because every time one opportunity is closed, another one is opened. But if you don't know where to look, you're going to miss the entire idea behind trading. And this is one of the best things that you can do. Now, I talked about this in depth in Vegas a couple of years ago for one of our Rebel Cons. I'm going to give you just a taste of it today, and in the future we'll do other topics and show you some of the nice little maneuvers and hedges, rolls, and morphs that you can do whenever you encounter dangers. So let's get started with that. What is a danger? Well, dangers are the situations that only expose you to losses. They really have no way that they can benefit you, or at least very small. So what happens is that you are accepting a risk for no reward, or again, just for very little. So the idea is that you don't want to try to manage a danger. Eliminate them. There's nothing to manage. The best traders in the world cannot manage that. But you have to be able to identify it, and this is where the trick lies. It's not always easy to identify. And that's because dangers are often hidden. So let's start off with a real simple example just to get the idea of what a danger is. And then you'll say, oh, that's pretty easy. But then I'm going to show you where it's not so easy and why it helps to be able to spot these. So let's take a look at a vertical spread. Let's say that you buy the 100-105 vertical spread. We'll use call options. And because we're buying the spread, you're going to buy the 100 call. You will sell the 105. And this, let's say, is a net debit of $3. Now, because there's a 5-point difference in these prices, that means the most that spread could ever be worth is 5. You spent 3 for it, so your maximum gain is 2. So what does that look like? Well, from a risk graph, this is what we get. Here's our bend at 100. Remember, we always get a bend at our strikes. Here's our second bend at 105. And this red curve is what's called the current curve. The blue one is the expiration curve. And so this red curve over time starts to slowly move towards the blue. So if the stock price rises out in this direction, this is our area of maximum reward, again, would be $2. But if the stock falls out this way, that's our risk. In this case, maximum risk of $3. But let's say that the stock moves all the way up here, pushing 120. What is this? Well, notice that little space between the red and the blue is getting pretty small. It might only be another 10 cents that you can squeeze out of this, which means that maybe this spread's trading for $4.90 in the open market. So even though theoretically it might be worth 5, you have to say, is it worth holding possibly for another 3 or 4 or 5 days to squeeze out that last 10 cents? Because it could go in the other direction and make you lose the full $4.90. Now, here's another thing where traders often get trapped. They'll say, well, it doesn't matter because I only paid $3. Or maybe I only paid $1. I don't have much risk in it. That is not true. Your risk is always the current price. Because in this example, you could close the position down right now, pocket $4.90. But because you're choosing not to, you are effectively putting $4.90 into the trade. That's no different than if you had sold or closed the spread for $4.90 and turned around and repurchased it for $4.90. Either way, you're still holding the spread for $4.90. That's really the risk that you have to focus on. So once again, a lot of traders will look at this and go, well, yeah, that's pretty obvious. I would know not to hold this at $4.90. All right, very good. Hold that thought. But here's where things can get tricky. What about spotting dangers in butterfly spreads? Remember that a butterfly spread is 2 verticals. So let's take a look at a butterfly spread and see if you can spot the danger and what you could do about it. Butterfly spread, let's say that we're going to buy $100 call We're going to sell 2 of a higher strike, maybe the 105, and then we're going to buy a 110. Notice we have these equally spaced, 5 points apart, 100, 105, 110. That would be a typical butterfly. If they're not equally spaced, we get into what are called broken wings, but this is a standard butterfly. But the thing to notice is that they are 2 vertical spreads. And now you're going to see why it's not necessarily so easy to spot them. You have one that's a bull spread and one that's a bear spread. So how are we getting 2 vertical spreads here? Well, those are the 3 trades that we just saw. Let's take this first $100 call on top, but we're only going to pair it off with one of the short 105s. That's a bull spread. That's a debit spread. Let's take the remaining short 105 and pair it up with the long 110, and that's a credit spread. And that's the bear spread. So it just kind of depends on how we pair these things up, but we can do this. Synthetically, we are holding 2 vertical spreads, one long and one short. So let's take a look at our 100, 105, 110 butterfly, and let's put it with 30 days to expiration. We'll give it a net debit of $1.50 and a maximum gain of $3.50. Now, these were put into a pricing model, so these numbers aren't cherry-picked and made up. This is pretty much how prices would work in the real world. So if we put this spread on, this is our risk graph. There's our long $100 call. There's our bend. There's the 105. We get a bend at 105. Those are the 2 short strikes. And then we have another bend at 110. That's the long 110. So if we have a current curve, might look like this in black, and over time, the center part here, this black, is going to move up towards the peak of the blue. Over here on the right, it's going to move down. So we get our maximum gain of $3.50 in this example if the stock is somewhere here in the center. We get the absolute maximum if it closes right at 105. We get our maximum loss out here into the wings. The stock is above 110 or below 100, we hit our maximum loss of $1.50. So once again, this black line is slowly going to move towards the blue. It's going to rise here in the center, and it's going to fall out here in the wings as time passes. But now, let's say that the stock, 15 days later, all right, we bought this with 30 days on it, 15 days later, that the stock is up here at 112. We're sitting on this red dot. And if the stock stays here, we're going to continue to sink. This is not an ideal situation, obviously. But let's say, based on new information, we feel that the stock is going to whipsaw in the other direction. So I often make the analogy, it's like a chess match. As your opponent moves, it changes the way that you think and the moves that you have. It's going to block some moves that you used to have. It's going to open up new opportunities. But what most people will do is they'll say, this trade is going against me. Let me just shut it down for a loss. And then they pat themselves on the back about, hey, I minimized my losses. Well, keep doing that and see what your ROI looks like. You have to have better methods for kind of defending yourself against these positions. Now, that's not saying that it's necessarily bad or in 100% of the cases that we try to roll it or morph it somehow. But if you're not understanding those choices, you are limiting yourself to those decisions. So I often make the analogy in our Q&As that it's like being a poker player or playing some kind of a card game. The best poker players in the world are not the best because they know which cards are coming. It's not because they have a better probability of getting a full house or a royal flush. You've got exactly the same probabilities. What makes them better than the average person is that given the cards that they were dealt, they can make better decisions. And over time, that edge starts to show. And that's the whole idea of risk versus dangers. So let's go back to our vertical spread. And what we can do here is say, well, wait a minute, with the stock way up there, out here to the right, up in the wings, let's go check the 100, 105 vertical. Remember, even though we look at our risk graph and it shows that we've got this curve in blue, it's really 2 vertical spreads. Let's go check the 100, 105. And based on those same numbers in a pricing model, again, these are not made up numbers, with the stock up here, this spread is worth $4.90. Exactly what we said was a danger before. But see, a lot of you spotted it when we just looked at it as a vertical spread, but you didn't spot it here. And it's every bit as real. So that is a danger. And what should we do here? What would you do if part of your trade is at maximum gain, keeping in mind that we think that the stock is going to reverse? Well, there's another little thing you can do. Split them up. All right, think of this, instead of you as holding both vertical spreads, look at two different traders. Let's say we have this guy over here who's long the 100-105 at 490, but his view is bearish. We've got this lady out here who's got the short 105-110 trading for about it's gone against her, it's minus 475, and her view is bearish. So they're both bearish, but what should they do? Well, this guy over here, because he's faced with a danger, should close it. And if she's bearish, can't do much worse. It's only going to go to minus 5, but she could do better. She can hope that it goes to 0, and so it's going to pay for her to hold. So look what happens. One person should close, one should hold. Well, now that you're the same person controlling both of these decisions, shut down the long one and hold the short one. All right, what does that do for you? Well, if we sell that 100-105 vertical, we get a net credit, let's say of 490, but we paid $1.50 for the butterfly. Remember when we did the initial trade? So now we've effectively paid $1.60. Why is that? Because we've shortchanged ourselves by 10 cents. We didn't allow for it to get to $5. So we've kind of dinged ourselves by 10 cents. So effectively our net cost is now $1.60, and therefore the maximum gain is $3.40. But we're now short the spread, so it means that we are now short the 105-110 for a credit of $3.40. You're going, wait a minute, how did I end up with a credit when it started as a debit? Remember that debits are credits, credits are debits. We're holding the short position. We shut down the long mathematically for $3.40. We used to have a $3.50 maximum gain. Now we've kind of been shortchanged by 10 cents. So the blue spread is the original one. And right now we're on the red. All right, but we have a maximum gain of $3.40, maximum loss of $1.60. What we've done is we have shifted that entire red curve down by 10 cents. But you're thinking, well, big deal. 10 cents isn't really a big thing to sweat over. But why did we do it? What was the advantage here? Well, remember what our outlook is. Given the new information, we think it's going to fall. And look at, we have a maximum gain for all stock prices below 105. See, before, if we hadn't shut this down, we would have maximum loss below 100, and we'd only have at least some gain between this break even here, which is 101.50 and 105. And we get the maximum gain at 105. That's the only time you're going to get 350. But now I can get 340 for all stock prices below 105. The probability is frighteningly higher of capturing that, given the fact that your outlook is correct. So there's a really good example, and still fairly simple, but I think that most people probably miss that. But this is why it's so important to be able to spot a danger. And the way that you do that, you have to understand your strategies and your synthetics and be able to peel these apart and saying, well, what am I mathematically holding? Once I realized that I was holding a long and a short spread, and I could see that the long spread is trading for close to maximum gain, let's get it out of there. And so hopefully that gave you a nice little introduction to risk and dangers. Again, we'll do more in the future. But the important point to see is that in order to get better at options trading, it's not just about knowing a strategy. There's nothing magical about a vertical spread or a covered call that just makes all the money in the world with no risk. That's what everybody looks for. They don't exist. What you have to do is to say, I'm getting dealt some cards, and once I find out what the cards are, and remember, they're going to change tomorrow and the next day and next week, what's my best move? And most traders will just look at that and say, oh, it's the same hand of cards. No, it's not. You're not understanding how to pick them apart and say, I technically have a different hand. And given that view, I now know a different trade to make. So if this sounds totally new to you or totally foreign, hopefully that's a really good incentive to realize that this is where coaching can certainly help. So if you're serious about your trading, there's a fabulous offer. You can get a free, absolutely free 30-minute one-on-one coaching assessment. You might even get it with Stu. You've seen him on Coach's Corner. We'll be seeing you on Thursday, or it could be with Elliot Katz or Scotty. But you can get a free one-on-one consultation. Pick a topic, say, how can you improve my trading? And let them show you some of these techniques. And that's what it's all about. That's going to greatly change things. So I hope that helps, gives you a new perspective on trading, because that's what we're here for. And again, I hope to see you on Thursday. I'll be in Miami on Thursday, but we're still going to do our Coach's Corner, 4 p.m. from down there, and I'll see you then.